Most people invest based on what did well the last 5 to 10 years. This has led to so many misconceptions around how people manage their money. And so in today's video, I'm gonna walk you through 5 investing charts that are gonna change the way that you view your investment portfolio and how you're gonna allocate dollars in the future. So the first one is really about just owning the S&P 500. If you're on social media like me, you'll see people all the time say, just own the S&P 500. And the problem with owning the S&P 500 is, look at this chart. The one thing that you're gonna notice when you look at this chart is how has US done versus international looking back on history. And when we look back on history, one thing that you'll see is that they typically switch off in periods of time. So we'll see an 8 to 10 year period of time where US does better, and then similar where international does better. Then it's gonna go back to US and back to international and back to US. And right now we're in a period of time where we've seen the longest US outperformance over international. And so some people say that and say, whoa, the world has changed, only own the US, but that's not what I believe. What I believe is that there's always a reversion back to the mean. And so we can look back on the last 150 years and say, here's what averages are across the stock market. When I look back at this, what I see is that I don't know what's coming in the future. I'm sure if you ask people at the last time where international outperformed for a long period of time, they say US is no longer the top country. It's not gonna be the best market. You should be owning just international. And the same thing happens right now, right? US has outperformed for a long period of time. Well, there's no way we're gonna go back. You should just own US. I have no idea what the future holds, and neither do you. I have an investment portfolio that is globally diversified based on mirroring the size of the market. So that's anywhere from 25 to 35% of the portfolio in international. The best thing that this does is it helps you avoid lost decades. So if you look from 2000 to 2008, 2009, the S&P 500 was flat over that period of time. So if you just own that, you wouldn't have any returns. But if you did have an allocation to small caps, international, et cetera, you would have a better return with your portfolio. We don't know what's coming in the future. We want to own a globally diversified portfolio, one that we hopefully avoid lost decades because we're diversified, and that is what's most important. So on to chart number 2. This chart is really what I call the periodic table of returns. And so if you look at it, it's going to show you based on asset class what did the best all the way down to what did the worst. And when you look at this, the one thing that you should notice is that things change, right? So what did the top of one year typically goes to the middle or below the next year. And then what did the bottom here oftentimes gets way or higher up. And so one thing that I see is people look at what did well last year and then they change their portfolio to allocate what did well to last year. But just like this shows, just because something did well last year doesn't mean it's going to do well this year. And so instead of, you just own US large cap, it goes from here to here to here to here to here to here. And you kind of have this still you don't really have a smooth ride. You kind of have this like all up and down high volatility. When you own all of these asset classes, you have a smoother ride and you end up with still pretty good returns. Okay, let's now go into investing chart number 3. Something that I see all the time on social media is, oh my gosh, the market is down 10%. We're in a recession. The world is changing. Everything is over. And this all comes from really just a lack of information. What most people don't understand is that volatility is part of owning stocks. It's part of owning the S&P 500. It's part of owning really any investment. If there wasn't volatility or risk, there wouldn't be returns. And so when you look at this chart, the one thing that I want you to realize is, whoa, the average drawdown on a yearly basis is around 15%. That's the average. Yet in 30 of the last 42 years, the S&P 500 still ended positive on the year. So what do I want you to take away from this? Understand that volatility is part of the journey. It's gonna happen. When you look at stock prices on a daily basis, it creates fear, it creates emotion, it makes you worry about, oh, is this all over? Do I need to sell? What do I need to do? Oftentimes the best thing is just to zoom out and not watch day to day. Maybe it's quarterly, maybe it's semi-annually, maybe it's yearly. But when you're investing for 30 years from now, what happens in a 1 day or 1 week period of time is not that important. Okay, let's go into chart number 4. This is really talking about average bear markets versus average bull markets. One thing that I see, especially from younger investors, is fears of recession. Recessions actually are a good thing for you. It's not a good thing if your job is cut, you lose your job, lose income. But what's good is that when you're an accumulator, you get to buy when prices are low. Buying at lower prices often leads to better returns over the long term. What I want you to understand from this is that recessions happen, right? What this is showing you is that there's recessions, there's going to be a ton of recessions over your lifetime. So the average bull market lasts 4.4 years with a cumulative return of about 152% during that period of time. And then the average bull market is just under a year, a little over 11 months, with an average decline of 32.1%. What should you take away from this? Well, what you should take away from this is that bull markets are longer, and bull markets typically see higher returns than bear markets see losses. So understand that you're going to have so many bear and bull markets throughout the rest of your life. It's normal. They're not going to be avoidable, and just invest continuously through them. Okay, so now this is the fifth chart. This is the last chart, and it's actually one of my favorites. One thing that you'll see all the time is that this time it's different, right? So we saw COVID, 2008 recession, wars, saw so many different things. And throughout that period of time, everybody is saying this time is different. This is the black swan event. The market's never going to recover. Oh my gosh, the world is ending. And that's just what the news does. All they want is clicks. They want ad revenue, and they know fear drives that. But if we look back on history and we look at this chart, what it's going to show you is all of the reasons there were to sell, and all the reasons why this time were different, and all the reasons why the stock market was never going to get back to normal. Look at where it is over this long period of time of history. Zoom out, avoid the news, and invest based on your risk tolerance, the right asset allocation, and invest based on your time frame. The biggest issue for most people is that they have too high of a risk for portfolio on a short-term goal, or they take too little risk on a portfolio that's long-term, or they sell out. You need to invest based on the time frame, based on your risk tolerance, and the more that you understand about asset classes and international versus US and history, the better investor that you can be. Thank you for watching. If you enjoyed this video, please leave a like and go follow my page for more personal finance content. And as always, if you have any thoughts, please leave it in the comments below, and I promise to get back to each individual comment. See you next week.